Okay, well, let's start. Good morning in Dubai, good afternoon in Hong Kong and Singapore, and good evening in Sydney and other places around Australia. My name is Tim Smith, the Managing Director for Asia Pacific for InvestSuite. I want to thank you so much for joining the webinar today. It'll be very concise and very informative around ESG, beating the benchmarks and returns. I wanted to just go through and introduce the InvestSuite team today. Would like to particularly introduce Joyce Chu. She's our wealth tech specialist located in London. She'll be the host for the upcoming webinar. Together joined with Emmanuel Verdiers, who's our head of quants, and product manager Martin Wins, both located in Belgium. Through the session, we'll explain how our proprietary fourth generation measure of risk, iVaR, and how it addresses the shortcomings of traditional risk measures. We elaborate on the importance of ESG for investment managers and how InvestSuite can help you in constructing and customising ESG scores. We demonstrate how Portfolio Optimizer can create portfolios with improved ESG metrics and at the same time optimise portfolio performance, all whilst maintaining investment strategies. And finally, we'll provide evidence of the approach via a live demo and various backtests. I'd like to hand over to Joyce now, and I wish you a good webinar. Thank you.
Thank you very much, Tim, and great to see everyone here. Thank you for joining us all over the world. A couple of reminders before we get started into the topics for today. First of all, if you'd like to change your view on Zoom, you can definitely do so on the top right corner of the gallery view. We suggest to change the view to either side-by-side speaker, where you'll see the individual that's speaking, like myself right now, or side-by-side gallery where you can see myself as well as all my colleagues. So feel free to make that switch right now if you are having any issues with seeing both the slide deck, which I'm presenting right now, as well as the speakers. Also, if you have any questions or comments, please feel free to enter them into the Q&A box, and we'll try to tackle them after each speaker as well as at the end of the webinar. So please feel free to place some questions on there. And of course, if we can't get to your question, we are more than happy to reach out afterwards as well. So first, again, thanks to Tim and thanks to everyone for joining us. I just want to speak a little bit about InvestSuite for those of you who haven't had the chance to view one of our webinars or of course engage with us or any of my great colleagues at InvestSuite. So first, we are a pure B2B player. What we aim to do is work with financial institutions, and what we are bringing to the market is digital investment management to the industry, to the financial services industry. We also understand and we appreciate that financial services and financial institutions like yourselves already have a strong credibility with your clients. That's brand recognition as well as lasting relationships with investors. And so what we do and why we're pure B2B is we want to support you and help strengthen those relationships with our solutions in a digital way that's going to address some of those on-demand, omni-channel desires of clients. So what the solution that we're bringing there is digital wealth and invest tech. We also have a great expertise in project governance, as well as we've had experience in launching digital tools, both in a B2B aspect, as well as within banks. Ourselves have also sat in the same seats that you're seating, where you are making these decisions and what solutions can we bring to the market to address some investors' changing demands. And so what we are also looking to offer is a fast go-to-market product and solution that you will be able to leverage. So first, a little bit about the company. We've started since 2018, and since then, we've actually grown to over 55 employees across 6 offices all over the world. We now have clients spanning across 7 countries and across 4 continents. And so we're always really happy to host these webinars, both in separate time zones so that we're able to address the demand that's happening all over the world, really. So far as an institution, we've raised over 10 million euros in funding, scaling up to our goal of really being a top global software solution provider. So what we're offering at InvestSuite is an exceptional combination of what we like to call left and right brain skill sets. And this is actually evident across our management team, our sales teams, as well as our employees, developers, and et cetera, company-wide. We cover expertise in banking and investment on that one side of the brain, as well as quantitative analytics, AI, and machine learning. Now, on the other side of the brain, we've got a lot of expertise in digital product development, design, branding, and marketing expertise. And we look at it from a behavioral finance and behavioral science point of view. And so what we're trying to do is really combine both these left and right brain skill sets to bring solutions that can help address both the capital markets as well as the interaction that the clients are looking for in these digital solutions. And so this combination of the skill set is really what's allowed us to offer advanced next generation tech that's at the same time still human-centric and beautifully designed. So our mission is actually quite simple. We want to help financial institutions realize their digital wealth transformation journeys. And there's three main areas where we feel we differ and add most value. And that's first our excellent and intuitive user experience and user journey. What we do is we study and improve the full value chain, looking to engage, inspire, alert, and nudge, as well as offer full transparency, which clients really looking for as they, put their trust through a digital conduit. All of this is user tested and built into our solutions that you can leverage. Second, we have a sophisticated AI and machine learning setup. We have our own portfolio construction framework and measure of risk, which is what the main topic of today will be. In short, what we're doing is creating long-term performing portfolios with less risk. And the last thing that makes us differentiated is our infrastructure and technical framework. So what we're offering here is a complex yet smooth backend integration. So we have modern APIs, cloud agnostic tech stack, and we also already have our own well-established connections to data providers and the best broker custody agents out there. And why infrastructure is important to us is because what we believe is to truly accomplish digital transformation is that you need to leverage a new ecosystem that consists of yourselves, core banking as well, and IT providers, management consultants, as well as fintechs like ourselves and our peers out there. We're always keen on exploring potential synergies to really bring the best of breed solutions that we want to allow you as a financial institution the control to really build that best of breed solution in combination with some of our peers out there. Here are a couple of our partners that we're fortunate to already collaborate with, and we're always looking to explore further collaborations. So as our name implies, we don't just have one solution. We offer a full suite of 4 complementary digital investment products. All are white label and can be offered with your branding. And unlike most firms, we actually offer this range of solutions so that we can meet different needs. And so we can also provide ongoing and additional solutions as you go through this digital journey. Moreover, we also understand that you have your own strategy. And so what our solutions are actually highly configurable to be able to accommodate the different types of models, whether it's discretionary, advisory, self-directed, et cetera. Today, we'll actually focus on our quant methodology and the portfolio optimizer and the various uses it can apply to. But I'm more than happy to discuss these other solutions that you see here, robo-advisor, self-investor, and storyteller at another time. And of course, we will also be doing additional webinars to provide a bit more insight on this. Here are the types of clients that we look to work with. As you can see, there's a handful of different types of clients, and we're also not tied to just these 12 here. So of course, retail banks, brokers, challenger and neobanks. And because we offer a suite of solutions, it allows us not just to, maybe not all 4 of our solutions will work for each institution, but perhaps 1 or 2. And so we look to always partner and see what will be the best fit for your needs. So now to get into the nitty gritty of today, I'm more than happy to introduce Emmanuel Wildiers. He will be going over human-centric risk and ESG. I'll pass it over to you, Emmanuel. Thank you, everyone.
Great. Thank you very much, Joyce, for the introduction. Let me just share my screen. So during the next 20 minutes or so, I will talk about 2 main topics. The first one is portfolio risk, and the second one is ESG integration. And I'll talk more specifically about how to incorporate both of those in the context of state-of-the-art portfolio construction. But first, I will give a little bit of historical background around investment philosophy, and specifically how different investment objectives have evolved over time. So what you see on this slide are a few key moments in the history of investing that have changed the way people look at investments forever. The first one on the left is the book Security Analysis by Benjamin Graham and David Dodge. It was published in 1934. And of course, it wasn't the first time that people looked at analyzing investments, but people mainly invested in companies that they thought were good. And so a good company equaled a good investment. And the contribution of Graham and Dodd was that they developed a comprehensive framework that gave guidance on how to calculate the fair value of companies, and specifically the concept that fair value equals the discounted future cash flows. So that way they could calculate the expected return of an investment as a difference between the fair value and the current market price. And from 1930 onwards, investors started really incorporating company valuation and expected returns into their investment process. Second main turning point was Markowitz's 1952 essay called Portfolio Selection. And again, he wasn't the first to emphasize the concept of diversification in investments. Actually, the concept of diversification was already mentioned in the Babylonian Talmud, which recommends to spread your wealth equally over land, business, and gold. But Markowitz was the first to create a mathematical framework that was able to quantify risk, as well as quantify the benefit of portfolio diversification. And so from that point onwards, rather than just focusing on maximizing expected returns, the focus shifted to balancing maximization of expected returns against risk and portfolio diversification. The third big change was more recent, and it's about incorporating measures other than investment risk and return into the investment process, such as the impact that companies have on wider society and our planet. And again, that concept is not new, but it's only been in the last decade that we've seen these objectives really being given equal importance compared to portfolio risk and return. It's hard to pinpoint the exact turning point, but one of the key ones was definitely a 2005 study by the UN in collaboration with dozens of professional investors, where the term ESG was first introduced. And their paper provided guidelines on how to incorporate environmental, social, and governance aspects into investment management. So what we do at InvestSuite is we take those concepts of risk, diversification, ESG, and we try and bring them into the 21st century. So how do we do that? Well, mainly in two areas. The first is hyper-personalization. So if we go back to our three types of investment objectives, if you think a company is cheaply valued and therefore an interesting investment for client A, it's also going to be an interesting investment for client B, at least from an expected return perspective. But once you incorporate risk, you need to have some kind of personalization because not everyone has the same tolerance for risk. And that's why in practice, we of course have different risk profiles. We have different portfolios for people with different risk tolerances, and that's kind of a personalization. But with the introduction of ESG, the importance of personalization has significantly increased. Contrary to risk, you can't really capture ESG in one dimension. Just asking how important the client thinks ESG is doesn't really tell you enough. Why? Because ESG is value-based. It's really influenced by cultural and personal preferences. So what's ESG for client A may not necessarily be ESG for client B. And as a consequence, we believe that the bank or asset manager, or even the retail customers themselves, should be making conscious decisions about ESG. Secondly, at InvestSuite, we focus on the human-centric approach. So human-centric means that the metrics that we use for risk and ESG should be understandable by investors, and they should also be aligned with what they perceive as being important. For example, the measure generally used to measure investment risk, volatility, is not very human-centric of risk, measure of risk, as I will explain in the next slide. So I'm not going to go into the full details of Markowitz's modern portfolio theory. I'll just describe the main idea. But this main idea is that you have a set of inputs, which are the estimates of expected returns, volatilities, and correlations of all of the assets in your investment universe. And then the outputs of the model is something called an efficient frontier, which you can see on the right, drawn as the blue line. And this efficient frontier will give you a portfolio that maximizes the expected return for a given level of risk. And so in this framework, investing is really easy. You just choose a level of risk you can tolerate, and the model will give you the optimal risk-return portfolio. And for his framework, Markowitz chose volatility, or the standard deviations of the returns, as the measure of risk. So the big question is, why did he choose that measure of risk? And actually, the main reason was a mathematical one, because by using volatility, he could derive closed-form solutions to his equations, which are really easy to work with. And furthermore, in the previous century, if you wanted to win a Nobel Prize in economics like he did, you had to have a very elegant mathematical solutions. Second reason why I used volatility is that he had built a mathematical solver that was very efficient at solving these kind of problems that incorporate volatility as a risk measure. And in 1952, computing power was about 1/1000th of what it is today. So of course, computational efficiency was very important back then. But what's the problem with using volatility as a risk measure? Well, to summarize, there are two problems. One is that volatility doesn't match how real investors perceive risk. And secondly, it doesn't match with how real investments behave. Just to illustrate, on the bottom left, I'm showing 3 strategies. So strategy 1 consistently loses money, same amount every single year. Strategy 2 wins money, but with some dispersion. And strategy 3 is similar to strategy 2, but has a very large positive return in 1 year. And I've now shown the strategy over 3 years, but imagine you have data for dozens of years. If you then calculate the volatility of these 3 strategies, you will see that strategy 3 turns out to be extremely risky with a volatility of 139%. And strategy 1 is completely riskless because it has a constant return and no dispersion. So what volatility says that from a risk perspective, we should prefer strategy 1. But of course, in practice, no real investor, even the most risk-averse one, will prefer strategy 1. Why? Because investors care about losses. They care about avoiding losing money. And if they do, regaining it quickly. They don't care about volatility. And of course, what I'm saying about volatility will shock very few people. It's quite well known, and that's why over the last decades, several alternative measures of risk have been developed. And apart from volatility, the most widely used one is value at risk, or abbreviated as VAR. It was developed by JP Morgan in the early 90s because their CEO wanted to have one single number every day measuring how much money their trading desk could lose. And it was later incorporated into Basel banking regulations, capital requirements. So it's really important up to this day. And how value at risk is calculated is that it's basically the maximum loss in a normal scenario. So it ignores the worst case scenarios. So to give a simple example, to calculate the value at risk at a 5% significance, you take your returns for the last 100 months, you throw away the 5 worst ones, and you calculate the worst return of the 95 remaining ones. Of course, you already see the first problem is that you throw away the worst case scenarios. And so the actual loss can be bigger, even much bigger than what value at risk suggests. But in terms of portfolio construction, it gets even worse because value at risk doesn't always recognize the benefits of portfolio diversification. But to give a very simple example, imagine we have a portfolio with one single bond. That bond pays a 5% coupon. It runs for 1 more year. And the company has a 4% probability of defaulting over the next year. So if you then describe the outcomes, there are 2 possible outcomes. One with a 4% probability is that the company goes bankrupt and then your return is minus 100%. or everything is fine, your bond gets paid back, you get the 5% coupon, and then your return is 5%. So if we now want to calculate the value at risk at the 5% significance level of this investment, we can actually fully ignore the 4% probability because it falls into the worst case scenarios that we can ignore. And value at risk just becomes 0 because in a normal scenario, the worst outcome is, well, actually not even 0, actually plus 5%. But if we then combine 2 of those bonds into a portfolio, the probability of one of the 2 defaulting, and let's assume they're uncorrelated, is going to be roughly 8%. So 4% for each company. And if one of the 2 defaults, then your loss is going to be minus 50%. So suddenly by diversifying into not even more risky instruments, just 2 similar ones, your risk shoots up from 0 to minus 50%. And actually, in practice, that's also a pretty big problem. For example, during the global financial crisis in 2008, rating agencies were often using value at risk to assign ratings to complex investment products. And in fact, CDOs were specifically designed to exploit this weakness of value at risk. They were hiding all of the risks into the tails, and they were layering instruments on top of each other to hide into tails of tails of tails. And that way they could get good ratings for instruments that actually had really big risks, as everyone found out later. And again, those problems are by now well recognized. So regulators are in the last years shifting away from value at risk towards other risk measures. And last decade, an interesting framework was developed, which is called coherent risk measures. And that's basically a list of properties that a good risk measure should satisfy. And here I'll discuss the 2, what I see as the 2 most important ones. One is monotonicity. So if portfolio A has better returns than portfolio B under every scenario, then its risk measure should be lower. And as we saw on the previous slide, volatility violates that. Portfolio 3 had better returns than portfolio 1 in every scenario, but it still had higher risk. So volatility violates the monotonicity property. The second property is sub-additivity. So that means that diversifying should never increase risk. So the risk of a diversified portfolio should always be lower excuse me, than the risk, the weighted average risk of the standalone investments. And as we saw on the previous slide, value at risk is violating the sub-additivity property. So what we wanted to do at InvestSuite is we wanted to design a risk measure that satisfies all of the coherent risk measure properties, but on top of that also satisfies the human-centric criteria. In other words, corresponds with how real investors perceive risk. So that's why we've developed our own measure of risk. We call that risk measure iVaR, which stands for InvestSuite Value at Risk. So the way we calculate is visualized on the graph on the left. So suppose we have the value of an investment portfolio over time, as calculated in the black line. If we then want to calculate the iVaR of this portfolio, what we first do is we calculate at every point in time the maximum value the portfolio has been at up to that point in time. And that's visualized as the top of the pink areas. And then the risk, the iVaR, is simply the sum of all the pink areas. So the sum of all of those differences between the running maximum value and the actual value. And so you can see that those areas are going to be bigger in case drawdowns are bigger, because then the height of those areas will be bigger. In case the drawdowns take longer to recover, because then the width of the areas will be larger. Or in case there are simply more drawdowns, because then there will be more of those areas. And so it's a very intuitive way of combining frequency of losses, depth of losses, time to recovery. And those are, of course, all aspects that real investors care about, contrary to just volatility. To look at it another way, you can interpret the behavior of the top of the pink areas as the behavior of a savings account. So it only goes up in value, it never goes down. And once you recognize that investment is riskless, then you can simply see iVaR as a difference between the riskless equivalent of a portfolio and the real portfolio, and the difference is calculated as the sum of the areas, so the integral between the curves. So what we've done is we've developed, based on this risk measure, our own portfolio construction methodology. Martin will talk more about that. So I'll conclude the risk part and I'll move on to ESG. So I'll start with a very quick introduction for those less familiar with ESG. So ESG, as I mentioned, is about incorporating aspects other than risk and return for the end investor into the investment process. And ESG is grouped into 3 pillars: environmental pillar, social pillar, and governance pillar. So the environmental pillar measures a company's impact on living and non-living natural systems, so air, land, water, as well as complete ecosystems, biodiversity, etc. The social pillar is about how companies deal with their different stakeholders outside of their shareholders, so workforce, customers, governance, wider society, etc. And finally, the governance pillar measures the quality of a company's systems and processes, which should ensure that board members, executives act in the best interest of long-term shareholders. So it's about solving conflicts of interest. What's important as well is what you see on the bottom left, SRI versus ESG. So SRI stands for socially responsible investing, and it's a term that's much older than ESG, but is mainly focused on excluding harmful activities. So it's kind of a binary exclusion filter. ESG, on the other hand, is much more nuanced. It's really a full integration into the investment process, and it also recognizes the positive effects that companies have. Why are we talking about ESG today? Well, to be honest, largely also because it's a very hot topic. If you look at the number of investors that are very interested in ESG, that's about half of the investors at the moment. Just 5 years ago, that was less than 1 in 5. So really a massive increase. But furthermore, there's also a much larger interest with younger generations. So we know that as time progresses, as those generations acquire more wealth, ESG will become even more important. But the main problem with ESG is that it is subjective. So what ESG data providers do is they combine a lot of information from companies, but also from other sources to estimate how ESG a specific company is. So here what I've done is we've taken the data from 3 ESG data providers, the 3 of the biggest ones, MSCI, Sustainalytics, and Refinitiv, and we've checked how consistent their ESG scores are with each other. And what you see on the top right is a measure called rank correlation. So it's how similar the scores of the 3 companies are, and those numbers are pretty low. If you look at other measures for companies like expected earnings, the correlations between different analysts is generally going to be 90% or more. So with ESG, it's in the range of 23 to maximum 50%. So ESG ratings really differ a lot between data providers for the same companies. And to make that a little bit more concrete, I'm showing ESG ratings for 2 very well-known companies, Netflix and Tesla, and their ESG ratings by the 3 providers. What you can see is that Netflix is scored very highly by Sustainalytics, very poorly by MSCI and Refinitiv. All the way around, Tesla is scored very highly by MSCI, much less by Sustainalytics and Refinitiv. So in the next slide, I'll explain a bit where those differences come from. And to understand those differences, we need to quickly go through how ESG scores are calculated by the different data providers. And of course, the methodologies differ between providers, but in general, they work according to the same principles which are shown in this pyramid. So we start at the bottom with the raw data, and luckily that raw data is ever expanding, especially in Europe, where regulators are forcing companies to report more and more information about their ESG impact. But apart from that, also many NGOs are calculating and providing data, and also rating providers will do internal estimations. And interesting on that raw data aspect, there's a lot of consistency between data providers. That's not where the main differences come from. So where are the differences coming from? Well, the raw data is combined into higher level metrics that you can use to compare between companies. So higher level metrics such as emission scores, human rights scores, etc. And to create those higher level metrics, they have to do some kind of normalization based on the raw data. Why? Well, if you look at, for example, CO2 emissions, energy and utility companies will have much higher emissions than technology or financial companies, but that doesn't necessarily mean that you want to give every bank a really good environmental score and every energy company a really poor one. You want to probably normalize between peers. But which peers you choose and which metrics you normalize and which you don't, is going to make a very big difference in the ratings and between the providers, and we'll see that in Netflix example. Another reason is that value-based decisions have to be made. Whether you think some investments are acceptable or not depends on personal value. So whether you think you should include pharma companies that produce drugs that can be used for abortion really depends on your stance on the subject. ESG providers need to make those decisions to arrive at a company score. And of course, different providers will make different decisions. So the next step is going from the category scores to the pillar scores. So the environmental, social, and governance pillar scores. And there the difficulty is that you have to combine lots of metrics that are basically unrelated. Let's take the social pillar as an example. Two of the components would be employee satisfaction and tax evasion. In the example of Netflix, employee satisfaction is really great, but Netflix is also setting up offshore companies in tax havens to reduce their tax burden. So how do you combine those two? Which relative importance do you give to employee satisfaction and to tax evasion? And the weightings you choose there have a very big impact on the overall social score. And the final difference is coming from combining the E, S, and G pillar score into the overall ESG score. So if a company, for example, scores very well on environmental and social, but very poorly in governance, how do you calculate the ESG score? Do you make it an equal weighted average, or are you going to penalize that bad score more heavily? So going back to our two examples of Netflix and Tesla, the rating provider decisions are what's causing the differences. So in the case of Netflix, environmental pillar is an important factor. So within its peers, so within media companies, Netflix actually has quite a big CO2 footprint. Why? Well, its data centers are very energy intensive, but on an absolute scale, if you compare to energy companies, for example, emissions are still very low. The MSCI and Refinitiv, they're going to put a big penalty on that environmental pillar, while Sustainalytics is looking more at the absolute values. Second reason of the difference in Netflix is what I mentioned earlier, the trade-off between employee satisfaction and tax evasion. Different companies are going to give those trade-off different weightings. Second example, Tesla is even more interesting as the rating differences are even larger. And why is that? Well, pretty much everyone agrees that Tesla is one of the world's leaders in environmental innovation. They're completely reshaping the way transport works. But there are also a few deep controversies, for example, about how they treat their workforce, the fact that they're opposing unions, the fact that they put people on unpaid leave in case of production problems. There's the management of the supply chain, there's sourcing of rare earth materials like cobalt and lithium, which can be quite controversial. And finally, of course, there's Elon Musk's own personality, the controversies around his acquisition of SolarCity, around the composition of his board, about his tweets. So from a corporate governance point of view, Tesla is considered poor on some criteria as well. So the overall ESG score of Tesla really depends on whether you think environmental innovation is key, and then Tesla is a great ESG company. But on the other hand, if you want to focus instead on worker rights, about really good corporate governance, then Tesla is perhaps less interesting, and that's what's reflected in the provider scores. So what we believe in at InvestSuite is creating a fully configurable framework that ensures that ESG is aligned with preferences and values of our clients, financial institutions, or even those of the end customers. But at the same time, we want to provide broad market exposure, so avoiding concentrated portfolios. So we can provide that fully configurable framework on 3 levels. Either we can work with the ESG scores from a data provider. If our client is happy with that, we can use them. Secondly, we can create customized ESG scores. So we can combine data from different providers, implement custom weightings, exclude specific activities that our B2B client thinks are harmful. And then we can use that customized ESG score in portfolio construction. Finally, on level 3, the hyper-personalization within our self-investor and robo-advisory products, we can give a say to the end customers about what they think is important. So their stance in nuclear energy, for example, where it's hard to make a decision for them. Personal sensitivity, some people will be very sensitive to global warming, to gender equality, etc. We can basically let the end customers make those choices. And now finally, before I hand over the words to Maarten, I will give a quick demo of a prototype that we've built at InvestSuite to align portfolios with ESG preferences. So let's start very simple. Let's choose a benchmark. In this case, we've chosen MSCI Europe. And we want to make sure that the ESG combined portfolio ESG combined score of that portfolio is better than the benchmark, while staying as close as possible to the benchmark in terms of returns. And what you see here is the way that's most easy to achieve is by avoiding the worst controversies. So that way we can significantly increase the ESG scores of the portfolio by avoiding controversy. But if you look at the actual ESG scores, they're not that much higher than the benchmark. So let's say we want to change that, and we also want to have the individual ESG scores to be significantly better. We can run this again, and it will still make sure the overall score is better, but now you see a much bigger difference on the E, S, and G scores. But if we dig down a little bit deeper now to the raw metrics, looking, for example, at the gender pay gap, that's still about 10%. So women in the companies in our portfolio make 10% less than men. If you look at the percentage of female managers, it's about 1 in 3, also similar to the benchmark. So despite the fact that our portfolio is better in overall ESG, on raw data, it's not doing that much better. So let's say we find those 2 things important. We can choose gender pay gap. We can give that an importance level. We can choose the percentage of managers, give that an importance level. And then we can, again, run our ESG booster. The overall ESG scores will still be much better than the benchmark. But if we now look at the individual social scores, what you see is a gender pay gap has reduced by 75%. It's now only 2.5%. The percentage of managers has increased, female managers, from 1 in 3 to almost 1 in 2. So that's just a demo. You can do a lot more. You can do specific exclusions. You can literally do anything. So with that, I will give the word back to Maarten. Thank you very much.
Emmanuel, thank you so much for the update on how InvestSuite, of course, views risk as well as ESG and how we can truly invest in this way, and how really we're continuously improving this within InvestSuite. Now I'd like to introduce Maarten Wins. He's a product manager for Portfolio Optimizer at InvestSuite. He'll go over the solution, which is really a tool to access all of the relevant topics that Emmanuel just spoke about, access iVaR as well as our ESG methodology and how this can be applied to various cases as well as strategies. Thanks, Maarten. I'll hand it over to you.
Okay, thank you, Joyce, for the nice introduction. So indeed, in this part, we will focus more on the practical aspects of our portfolio optimizer. We will start by illustrating the difference between absolute risk and relative risk, how we do that within the iVaR setting. Next, we will demonstrate how to use our portfolio optimizer to focus both on performance and ESG performance. And of course, all while maintaining our extensive possibilities for hyper-personalization. And then in the last part, we will show you some scientific validation of our methodology. Now, circling back to the title of this webinar, Beating the Benchmark in Returns and ESG. When talking about beating the benchmark, the time horizon is of course crucial. If you're only concerned about not underperforming your benchmark on a very long term, then iVaR might be very well suited and it can give you a smooth ride with limited drawdowns. On the other extreme, if you don't want to underperform the benchmark, even on a daily basis, for example, then you're almost forced to track the benchmark as closely as possible. And their relative iVaR can be extremely useful. So with relative iVaR, we define risk as the drawdowns versus the benchmark and also the time to recovery of those drawdowns versus the benchmark. So we put it all in a relative way. And also in the view of what Emmanuel explained in the previous part, we believe that from a mathematical point of view and from a human perspective point of view, iVaR is a much better measure of relative risk than, for example, tracking error. So this is explained on the current slide with a small example. So for example, here as a benchmark, we considered the Microsoft stock. And we tried to find alternatives with the lowest possible tracking error. And then from our research, it showed that over the last 3 years, both Adobe and Alphabet were among the stocks with the lowest tracking error versus Microsoft. However, if you look on this graph at their performances, they're very different. Sometimes Adobe outperformed Microsoft, sometimes it underperformed Microsoft. But when you look at Alphabet, they underperformed Microsoft on almost every possible of the subperiods over the last 3 years. So it has a very large relative drawdowns versus Microsoft. And as you can see, they don't recover from those relative drawdowns. So if one would have to select an alternative by using tracking error, then there is hardly any difference between Adobe and Alphabet for replacing Microsoft. However, if you would look at time series and if you would consider iVaR as a measure of risk, then there is a clear preference for Adobe. So this being, let's say, the last bridge between the theoretical part and really the practical part, where our portfolio optimizer can serve as a cost-effective solution for more efficient portfolio management. And to show the broad capabilities of our portfolio optimizer, I would first like to present the different use cases. So at InvestSuite, it all started with our robo-advisory product. And the portfolio optimizer can be right at the heart of a robo-advisory product. And it can create their hyper-personalized portfolios for each end investor. But after a while in our company, we got more and more interest in our optimizer as a separate product. And for example, a large Danish pension fund is now using our portfolio optimizer to manage part of their European equity fund. So in that application, the client can really define his fully customized universe of instruments. It can be ETFs, it can be stocks, bonds, and we even have a client that uses our optimizer to construct portfolios of cryptocurrencies. So even that is possible. And next, given the universe, of course, all additional requirements of our clients can be taken into account in our portfolio construction. In the third application, there our clients can define part of the portfolio, and our portfolio will give the optimal weights for the rest of the portfolio. And by introducing the concept of relative iVaR and relative risk using iVaR, we can also offer direct indexing for index tracking applications. And as we will show later on, by using relative iVaR, you can really have improved index tracking applications. Of course, all of these applications can be fully customized, and they can also be augmented with one of our two differentiating features. On the one hand, we can offer explicit flow protection to the portfolios. And on the other hand, we can use all the techniques that Emmanuel just explained, and we can boost the ESG performance of your portfolio. Now, to come back to the first application, the robo-advisory, here, of course, we are very proud to announce that the Commercial Bank of Dubai recently launched the first robo-advisor owned by a bank in the Middle East. And their CBD investor is powered by InvestSuite. Each client that uses this app has a unique portfolio constructed by our portfolio optimizer. So that was about our measure of risk and the applications. But now, how does the optimization framework work in itself? As Emmanuel explained, we have a very unique and differentiating risk framework. But of course, on top of that, there comes a lot of parameterization options that allows for full customization at scale. So the first optimization that can be chosen is in terms of objectives. Do you want to use traditional iVaR, let's say, and you want to aim for a smooth ride and limit the drawdowns and time to recovery in your portfolio? Do you want to use your relative iVaR, and do you want to avoid underperformance of a certain benchmark and minimize time to recovery versus that benchmark? Or do you say that, okay, ESG is very important to me, and I really want to focus on the sustainable aspects of my portfolio? As explained earlier, this can be done by using ESG metrics of a data provider, by constructing your own ESG metrics, or by using even individual, let's say, ESG metrics like equal pay and so forth. Of course, on top of these goals, there is still a full customization, both for the financial institution and even the end client. And it's of course clear, sorry for this, that you don't have to choose just one of the objectives. They are not mutually exclusive. Each of the goals can be selected as an objective, and you can just select for each of the objectives the way they should get in the optimization, and then our portfolio construction framework will do a smart trade-off. Of course, as I said, there is a lot of customization on top of that, and it is customization at scale, because our portfolio optimization tool is deployed in the cloud and can be accessed via our state-of-the-art APIs or via our B2B web interface. It's easily accessible and it's very flexible to integrate. And in case of the robo-advisory solution, it's even possible to do a direct integration with the broker custodian. As touched upon earlier, our portfolio optimization tool and our portfolio optimization framework can handle a lot of instruments. You can really select your universe of ETFs, funds, stocks, and as said, even cryptocurrencies. So we have a client live using our portfolio optimizer for constructing portfolios of cryptocurrencies. We apply your policies in the portfolio construction methodology. So in terms of rebalancing, this can happen periodically, but it can also be done by our smart rebalancing algorithm. And of course, when proposing trades, our portfolio optimizer will take into account your transaction costs, position limits, etc. So we will do a trade-off between paying transaction costs and doing trades in your portfolio. As InvestSuite is a B2B software provider, we don't give explicit views on markets. Of course, when you have any specific views from your investment committee or whatnot, of course, your views can be incorporated by, for example, setting limits on asset allocation, sector allocation, or you can even provide us with your expected returns for instruments, and then we take them into account in our portfolio construction methodology. To come back again to the iVaR point in combination with ESG, as touched upon earlier, there's really a full flexibility in terms of setup. In terms of ESG performance, we can offer customized scores. You can choose standard ESG scores. You can replace stocks that have the largest negative influence on your portfolio. But on the same thing, you can do positive and negative selection on your universe. And of course, all of this is data provider agnostic. We have a general methodology and we're not tied to one specific data provider. And of course, also in terms of financial performance, you can go both for minimizing iVaR, where you go for stable growth in your portfolio over the longer term, or you can minimize relative iVaR and aim for a smooth ride, let's say, versus your benchmark.
All right, Martin, thanks so much for sharing the different uses of iVaR, both through Optimizer and ESG Booster, and of course the configuration possibilities. We have about last 10 minutes, so hopefully we could demonstrate how InvestSuite has validated this in practice across global markets and some of the people or some of the markets of our audience today.
Yes, sure. So indeed, in this last part, I can touch upon our scientific approach for validating our strategy, because of course we have done a lot of backtests to verify our methodology, let's say. And for this specific webinar, so in an earlier webinar, we touched upon the Stock 600 index in Europe, but now we considered the S&P ASX index in Australia to make it more personal for this webinar. So in this first backtest, what we did is we applied an optimization at the end of each month, considering all instruments of the ASX 200 at that point in time. And of course, only using all time series up until that point in time. And then we did two things. We first constructed a portfolio purely with iVaR. So there we focused on minimizing iVaR in your portfolio. And the second backtest we did is where we put 50% weight on limiting iVaR in your portfolio and 50% weight on limiting relative iVaR in your portfolio. So 50% you tried to avoid drawdowns in your portfolio and 50% you try to avoid drawdowns versus the benchmark in your portfolio. And then this were the results that we got from this backtest. So typically what we see is that by limiting drawdowns over longer term, you can create a nice outperformance. And also if you put focus on relative iVaR, let's say you can follow the benchmark and still have the benefits of limiting the drawdowns. So if you look here at the yearly returns, it really shows how our methodology works. So in negative years like 2002, 2008, 2011, our methodology is really capable of limiting the drawdowns, of limiting the losses in your portfolio, and of course also putting a focus on limiting the time to recovery. However, in years like 2009 or 2018, where there is a huge rally in the market, if you just put your focus on minimizing absolute risk, there is a possibility of having a rather large underperformance versus the benchmark. But if you combine our methodology of absolute risk and relative risk, you really see that you can still limit the drawdowns in your portfolio, but you also make sure that the possible underperformance of the benchmark is much more limited. So that's the dark red line on this graph. So really doing a trade-off, let's say, between having a smooth ride in the longer term and really benefiting from this compounding effect on the longer term and not underperforming the benchmark on a shorter period. And on the last graph I wanted to show on this backtest, it shows really, let's say, the height of the drawdowns you can have in your portfolio. So for example, the 30% bucket shows on how many days your portfolio was more than 30% lower than its previous peak. And then what you really see on this graph is that by limiting the risk in your portfolio, the moments of really large drawdowns, of huge drops in your portfolio versus the previous peak can be very much limited. And by using the concept of relative iVaR and absolute iVaR and combine them, you can really do a trade-off between both of them. Then the next backtest we applied was with an ESG flavor. So first we have again the pink line, which is the absolute version of our methodology. And then we added on top the green line, which is with an ESG flavor. So we put both in the objective, the absolute iVaR methodology, but also the ESG aspect of your portfolio. And then typically you see that still by using the concept of iVaR, the drops in your portfolio are very much limited. And also, if you look at the drawdown graph, you have very limited drawdowns in your portfolio. But if we go to the next graph, this graph shows the ESG performance of all three portfolios. So first from the index, the blue line, the pink line is the standard iVaR portfolio, and the green line is where we put also ESG in the objective. So this really shows that you can still limit drawdowns in your portfolio, but you can also put a very strong focus on ESG in your portfolio. And of course, here we just used the general overall ESG score, but you can equally well use individual ESG scores. So that's the thing I want to show in this last backtest. So here, a prospect in the US asked to us, okay, we want to track as closely as possible the S&P 500 index with a maximum of 100 instruments and with no tobacco stocks in the portfolio. So they really had the ESG preference of having no tobacco stocks. That's what we did here. And then we applied our methodology of purely relative iVaR to track as closely as possible this S&P 500. So we really see that we were able to do this very well. And also, if you look at the yearly results, on the year-on-year results, we see that we are very much able to track the S&P 500 very closely, with only picking 100 stocks at each point in time out of the 500. And important here to notice is that our methodology can be an improved version of relative risk, for example, using tracking error. So we did the same exercise, but with using minimizing tracking error instead of minimizing relative iVaR. And typically what you see if you use minimizing tracking error, that the under or outperformance, which you see on this graph, it's turning around the performance of the benchmark. But if you put focus on relative iVaR, then you're putting only a penalty on underperformance of the benchmark, and also when your portfolio doesn't recover from this underperformance of the benchmark. So typically you see that we aim for this smooth ride in terms of under and outperformance of the benchmark. And that really pays off, because here on the last slide of this backtest, you see the 3-year rolling relative return of each portfolio versus the benchmark. So if you look at these 3-year rolling returns, you see that for our InvestSuite methodology, for each 3-year rolling window, we had a positive return versus the benchmark. Whilst if you would have used minimizing tracking error as a methodology to construct your index tracker, let's say, you would both have positive 3-year rolling returns, but also quite some negative 3-year rolling returns. So this really ends up, let's say, the presentation where we showed how you can use iVaR both in an absolute way and a relative way, and you can really combine all kinds of ESG aspects in all sorts of ways in your portfolio construction methodology. Of course, still, let's say, putting focus on every aspect of hyper-personalization that is standard within our offering.
Thank you very much, Martin. Just mindful of time here, we have our last minute. So we do have a couple of questions, but we will be responding directly via email. So you will get an email from Martin or Emmanuel directly from them. If we could perhaps just summarize today's call. Of course, we learned a little bit about iVaR, which is a 4th-generation human-centric methodology of quantifying risk unique to InvestSuite, hence the name InvestSuite Value at Risk. Of course, Martin went highly through Portfolio Optimizer, which is a tool that allows you to capture this methodology, both to construct, optimize, as well as to track indexes. And of course, as we learned today, to boost ESG performance as well. And the backtest, which we will make available, as you can see, it does scientifically prove that there are less drawdowns, faster recovery, and a smooth ride, which is essentially what investors are looking for. And last but not least, we do have 4 solutions. Storyteller here is quite unique to InvestSuite and will actually be the topic of our next webinar over the next quarter. So I'm happy to tell you a little bit more about that. And in the last minute, I'll just show you our contact information. You can see Martin, Emmanuel, myself, as well as Tim Smith, who is the Managing Director of your region, Asia Pacific. Please feel free to connect with us via email right here. And of course, follow us on LinkedIn or visit our website. And you can search InvestSuite on Google. So thank you very much. And we look forward to seeing you at our next webinar. Thank you, everyone.